If you're delving into IFRS 9, I will tell you to stop. Before you can account for financial instruments, you need to understand what they actually are. Have you ever wondered why some financial instruments are categorized as liability and others as equity? Have you wondered why some preference shares are categorized as liability and the same preference shares in other situations are categorized as equity? So if you have, I want to tell you that IAS 32 financial instruments presentation is a standard that provides the foundation for us to understand and to know whether to categorize financial instruments as liability or as equity, or if we are to categorize them as something in between the two of them. So for you to understand financial instruments, IFRS 9 properly, you need to master IAS 32 financial instruments presentation. This is because if you master IAS 32, then IFRS 9 becomes 10 times easier for you. So if you're ready, let's delve into it. At the end of this video, you will understand what IAS 32 is all about. You also understand the difference between financial assets, financial liability, and equity instruments. Also, you understand how to classify financial instruments correctly. And also, we're going to explain what compound financial instruments are, those ones that are not clearly liability and they are not clearly equity. So we're going to understand them and see how to account for them. Also, at the end of this lecture, you should be able to know what treasury shares are and how to account for them. And then you also understand offsetting rules. You know what it means to offset. You have a receivable, you have a payable. So to get the net. Actually, the standard does not allow offsetting, but there are conditions that must be met before you offset, if you must offset. So we're going to learn what those conditions are for offsetting. So we're going to learn offsetting rules. And then lastly, we're going to look at exam traps as usual. And we'll look at exam tips. We'll look at, so if you're going for a professional examination like ICAN, ACCA, CPA, CMA, other professional examinations, accounting examinations, we're going to give you the traps that examiners usually use. And if you're going for an interview also as an accountant, we are also going to guide you. So I urge you to subscribe to this channel if you have not already done so, and to follow us and to share with someone who is studying accounting. So my name is Sechala Okori. If you're ready, let's delve into this lecture. We want to start with the foundation. IAS 32 financial instrument presentation. So what is the goal of IFRS? That's what is the goal of IAS 32? The goal of IAS 32 is simple, is to establish the label for us to know how do we categorize what we own and how do we categorize what we owe. So these are the two things. Next, we're going to look at the scope. What is the scope of IAS 32? So it's about the presentation, the classification, and offsetting. So how do we present financial instruments? How do we categorize them? And how do we offset? What are the rules, the conditions to be satisfied before you can offset if you must offset? So it applies to all entities and all financial instruments except those ones that the standard removes. So they are specifically exempted items. Except for those ones, it covers all financial instruments of all entities. So what is the big picture? The big picture is simple. It is about category. It decides the category. IFRS 9 decides the value. What is the value of the financial instrument? That is IFRS 9, which we are going to look at after this lecture. This is our next lecture. We're going to look at it. As I said, it is expedient to understand IAS 32 before IFRS 9. So IAS 32 decides the category. IFRS 9 decides the value. Good. So now we're going to look at why IAS 32 matters. Why does it matter? What is the connection to IFRS 9? Classification must happen before measurement. That is a fact. So if you don't classify correctly, what you are measuring will be wrong. Your measurement will be correct, but you are measuring under the wrong category, and that is already wrong. So classification must happen, and then measurement, the correct measurement will follow. So if IAS 32 says it is an equity, then it stays at cost, no fair value through profit or loss. But if IAS 32 says it is a liability, then it usually triggers what we call interest expense. Okay, that's finance costs. And then you also have IFRS 9 valuation rules we follow. Then IAS 32 also deals with presentation. It does not deal with the following. I want us to note carefully. It does not cover recognition. It does not cover measurement. It does not cover ECL. That's expected credit losses. That is not the job of IAS 32. That is the job of IFRS 9. Next, we want to look at some key definitions. These definitions will help us to understand financial instrument very, very well. So what are the key definitions? First, we want to ask, what is even a financial instrument? A financial instrument has three parts of definition. Firstly, it is a contract between two parties. Okay? You know what a contract is. So it is a contract between two parties. And the contract creates a financial asset for one party, and then in the other party, it creates either of two things. It creates a financial liability or equity instrument of that other company. So this is what a financial instrument is. It's simply saying that a financial instrument is a contract between two parties that creates in one party financial asset, and in the other, it creates either a financial liability or equity instrument. So as we go ahead, we're going to understand all of this. It looks technical, isn't it? But it's not so difficult. I want to encourage you to watch this video to the end. It is not difficult at all. Good. So we say it's a contract, okay? Now, what are the examples of financial instruments? First one, cash. Cash is a financial instrument. Bank deposit, financial instrument. Trade receivables, trade payables, loans, bonds, shares. These are all examples of financial instruments. So as we said, a financial instrument is a contract. If you share this definition into three, it makes more sense to you. So we say it is a contract between two parties. And then this contract between two parties creates financial assets in one and creates either of two things in the other. The other two things is what? It creates financial liability or equity instrument. So this is what a financial instrument is. Now, let's look at what financial assets are. Let's look at the meaning, and then let's also look at what financial liabilities are. And of course, we all know equity. We already know equity. Ordinary shares. Is it an ordinary share capital? That's equity. So now we say assets. So when we say financial assets is cash, contractual right to receive cash, or another entity's equity. So this is what a financial asset is. That's a financial asset could be cash, ordinary cash, which is cash at hand or cash in the bank is cash. Then it could be a right to receive cash. You might have a right. You might have a document in your hand that gives you the right to receive cash, isn't it? So once you have a contractual right to receive cash, there are so many examples of that. I want you to think of them. Maybe a check, so many others. So once you have a contractual right to receive cash, it's a financial asset. Another one is if you have a contractual right not to receive cash, but to receive another entity's equity, then that is also a financial asset. You see that? So you could have a contractual right. It could be cash, that is basic, or it could be a contractual right. By contract, you have the right to receive cash or to receive the equity of another company. So this is what we mean by a financial asset. Now, what is a financial liability? A financial liability is the mirror opposite. It's a contractual obligation. Always remember to go back to the framework, the IASB framework. It will guide you on what an asset is and what a liability is, so that when you're talking of financial liability, financial asset, you can link it to that big explanation and it will guide you. So you can see that liability is the mirror opposite. So when we say financial liability, we're saying that it is a contractual obligation to do what? To deliver cash or another financial asset. So you have an obligation to either deliver cash or to deliver another financial asset. So this is what a financial liability is. Then the key word here in financial liability is what? contractual obligation. So it's a contractual obligation. It is not just an obligation, but it's a contractual obligation. So we say financial liability is a contractual obligation to deliver cash or another financial asset. Next, let's look at the core concept. What is the core concept? The core concept of IAS 32 is telling us about substance over form. What do we mean by substance over form? So students often think that if it is called a share, then it must be equity. What if it's preference share? You see preference shares, some preference shares. Most preference shares are not equity. Okay? So the preference shares, because preference shares are treated like bonds, they have a fixed interest payment. It is fixed. Their payment is fixed. And it's written on the body of the document of the preference shares, written on it. It could be 5% preference share, 6%. Have you seen ordinary shares carry percentages? No. Okay? When students think that, it is wrong. This is not to say that some preference shares, there are special preference shares that also could be converted into ordinary shares. We're going to talk about that much later. But usually, when you see preference shares, don't think of equity. Students often think that when it is called a share, it must be equity. That is wrong. Now, IAS 2 says what? Classification depends on substance, not legal form. Now, let me explain substance over legal form, even though there's a video I did on it when I was talking about accounting concepts, all those prudence, going concern, substance over form. You can go and watch it and come back, but I will still explain it here. So, substance over form. When we say substance, we're talking about economic reality. Now, when we talk about form, we're talking about legal form. The legal formation of that contract or entity or whatever. Legally, by law, it is saying something. But the economic reality is saying something differently. So we are saying that we prioritize the economic substance, the economic reality, the economic implication over the legal form. That's the way it is recognized by law. By law, it could be that you own it, but the economic reality is different. It doesn't care that even though the person does not own it, is a person collecting the risk and reward. This is just for illustration. So the name of the instrument is irrelevant. Don't look at name. Don't look at, once you see preference, you see share, you think it is equity. No, don't look at the name. So the name of the instrument is irrelevant. What matters is the economic reality. So don't just look at the legal name, e.g. you see shares. You look at it, you know that the name is saying shares, so it should be equity. No, don't do that. Look at the economic reality. And by economic reality, we're saying whether the company is obliged, has an obligation, a contractual obligation to make payment. If it is ordinary shares, the company does not have that contractual obligation to pay dividend. No. But for preference share, there is usually an obligation in contract to pay. So you look at the economic reality and not the legal form or not the legal name. So look at the economic reality, okay? Now, if the company must pay back the money, it is a liability, even if it is called a share. Next, I want us to look at an example. Suppose a company issues preference shares. The share requires annual dividend of 10% and mandatory redemption after 5 years. You see this typical example. It's a preference share. Can you see the name is saying preference shares? You can see shares. But we are told that there's annual dividend of 10%. Have you seen any ordinary share carrying 10%? No, ordinary shares don't. Ordinary shares don't carry percentages. So this kind of share that carries a percentage, we have to look at it with suspicion. It means it is more of a liability. In fact, in this case, this example, you have to pay them. You are obligated to pay the dividend to them. So it is not an equity. It's not an equity instrument. It is a liability. So we say the share requires annual dividend of 10% and a mandatory redemption after 5 years. The question is, are these equity? Many people say yes because they are called shares, but they are wrong. IAS 32 says no. Why? Because the company has an obligation to pay. To pay what? To pay dividends. Of how much? 10%. You have to pay annual dividend at 10%. So that is an obligation, a contractual obligation which you must fulfill. And also it has an obligation to repay the principal. After 5 years, you have to repay the principal. Therefore, they behave like debt. So it is not equity at all. So I hope this example clarifies it. Let's go to equity or liability. How do you know? Is it equity or is it liability? This is the critical distinction that I want to explain to you. How do you know? If it is equity, there is no contractual obligation to deliver cash. You have residual interest. For ordinary shares, that's equity. If every other person has been settled, you have the asset. Once all the liabilities have been settled, it is the residual interest that we call equity. That is what belongs to the ordinary shareholders. But for liability, you have a gun to your head telling you that you are legally forced to pay their interest and also to pay principal. So you have to pay particular percentage and you have to also pay the principal. So once, this is a guiding distinction, always remember, and that is what we call substance over form. Don't look at name, don't look at shares. Look at the economic reality. Is a company under obligation to pay? If that, then it's a liability. But if there is no contractual obligation to pay, to deliver cash, then it is equity. Because that rests on what? Residual interest. So the settlement option, is it cash versus less cash or shares? So one, settling in a fixed number of shares, it is usually equity. So when you are going to be settled with a fixed number of shares, that is usually equity. That's a guide. Settling in a variable number of shares based on a cash value, that is always a liability. Okay, so we're going to look at accounting treatment of dividends versus interest. For liability, liability is debt, isn't it? So payments, how do you treat payments? Payments are treated as interest expense, finance cost, isn't it? And it is shown in the profit or loss. That's the income statement. How is it showing? It is shown as finance costs in the income statement. That's the statement of profit or loss, another comprehensive income. That is how liability is treated. Can you see the difference? So the interest expense is showing there. And what does it do to profit? It decreases profit. Okay, now let's go and look at equity on the other hand. For equity payments, they are treated as dividends, not expenses. Okay, when you pay out to your shareholders, it is dividends. We don't treat them as expenses because they are not expenses. They are dividends. And they are paid from retained earnings. It's from inside retained earnings that we pay them. And they do not reduce profit at all. Okay, because profit is calculated in the income statement. Okay, and that is from there that you pay the liability. You pay your finance cost from there before you arrive at your profit. So that one reduces profit. But dividend is not paid from there. It's not from income statement. Your retained earnings is inside the balance sheet. It has already been transferred from income statement to the balance sheet. It's part of your reserves. So it is from there. So it does not reduce profit. Okay? It does not. So this distinction is very, very important. Good. Now let's look at compound instruments. There are some instruments that are both equity and debt. Okay? Those are the confusing instruments. They are on this side, like the bat. You know, the bat that will come before all the birds. And they say, oh no, all the birds, you are a mammal. The birds are not mammals. We don't know you. And then he will go to the mammals and the mammals will say, we don't know you. We don't fly. How come you are flying? So that's the bat. So these are the compound instruments. So let's look at an example of it. Convertible bonds. There's some kind of bonds that can be converted to ordinary shares. So how this is a typical example of an instrument that has both. They are convertible. So step one, how do you treat them? You calculate the liability part first. And to calculate the liability part, you have to get the present value of future cash flows. So we keep talking about present value. In accounting, is good. That's why I always emphasize present value. You have to discount to present value. Why do you do that? Because of the time value of money. And what is the time value of money? 1 naira today is more than 1 naira tomorrow. Because of what? Because of uncertainty, because of risk, because of inflation. Because of time, basically. So we call it time value of money. Okay? So because of that, when you are calculating liability, because the liability is in the future, you have to discount it to present value. So you calculate when you have that kind of mixed instrument, an instrument that is compound, that has partially equity, partially liability, what you do is you treat the liability part first. And to do that, you have to calculate the present value of future cash flows. Step 2, you now get the residue. That's the difference between the proceeds and the liabilities. And that is what we now call equity. So you take the proceeds of the issue, you less the liability part from it, then whatever is left is what we call equity. So note, you never value the equity part first. Never do that. It's not allowed by IAS 32. Let's look at a practical application, a case study. Let's say preference shares, which is usually the common trap. If they say it is redeemable, what does it mean? It means the company must buy them back. So it is a liability. Check the dividend clause. Is the dividend mandatory? If yes, then it's a liability. Now, let's look at an example. A company issues bonds worth $1 million. Investors can receive repayment in cash or convert into ordinary shares. This instrument contains liability element, that is the right to receive interest and principal, okay? And it also contains equity element, that is conversion to ordinary shares option. Are you seeing it? Therefore, both elements exist. So IAS 32 requires separate accounting. Means you have to treat one as a liability and treat the other as equity. And let's go and look at offsetting. What is offsetting? Offsetting, as I said, you are expecting, it's like you are dealing with a customer. You owe the customer and the customer also owes you. Okay? So at the end of the day, you have to net it. That is what we call offsetting. You net it so that you can get one figure. Okay? Whether it's a payable or a receivable, you net it. So I'm owing you 1,000 and you're owing me 500. That means what is between me and you is actually 500 because we can net that. So that is what we call offsetting. So the standard does not encourage offsetting, but you can offset an asset and liability if you meet these two conditions. One, you have a legally enforceable right to set off. Legally enforceable. That means by law, there's a contract. It is stated in the contract that you have a legally enforceable right. You can go to court and you win the case that yes, this is already in your contract that you can offset. So if you have a legally enforceable right to set off, then it is allowed. That is one. Number two, if you intend to settle on a net basis or simultaneously, then it is allowed. These are the two offsetting rules by IAS 32. Now let's look at accounting for convertible bonds. Step 1, these are the steps I want you to understand. We'll explain what convertible bonds are. Okay? So number 1, you measure liability component first. Number 2, and to do that, you have to determine the present value of future cash flows as if there were no conversion option. I think we explained that before, but just to reiterate. And step 2, you subtract liability value from total proceeds. Then step 3, the balance is your equity. Simple. So what it means is the equity component, to get it, is equal to what? The issue proceeds less the liability component. Example, if the issue proceeds is $1 million and liability component is $920, then the equity component is simply $1 million less $920,000. Then it will give us $80,000. So presentation, what do? Liability will be treated $920,000. That is the liability part. And the equity part will be what? $80,000. But in any case, you must do the liability part first. Let's look at putable instruments. What are putable instruments? Putable instruments allows investors to require the company to repurchase the instrument. So if you have a putable instrument, as an investor, you can require the company to repurchase that instrument from you, and the company will have no choice but to repurchase it. So that's a putable instrument. Okay? Normally, repurchase obligation means liability. It means liability because the company has a liability to repurchase. You can ask anytime that they should repurchase the instrument from you. So that makes it a liability. However, IAS 2 has some exceptions. There are some limited exceptions. So certain putable instruments may be classified as equity. okay, if specific criteria are satisfied. So for most examinations, I want you to remember that putable instruments are generally referred to as liability. They are generally categorized as liabilities unless the exception applies. So it is only in rare cases where exception applies. That is when putable instruments are equity. If not, they are usually liability. I hope this is clear. Now, treasury shares. Let's look at treasury shares. How to account for buybacks. You know, when a company buys its own shares back, it is the treasury share, okay? So the rule is simple. They are deducted from equity. And it is crucial to note that no gain or loss is recognized in the P&L on the purchase or sale of treasury shares. Good. Now, let's look at this checklist, which will help us. For every financial instrument you want to analyze, these are the things you should ask yourself. Is there an obligation to pay cash? Is it a fixed share swap? Have I separated the debt and equity components? So the next step. Now that we've classified it, let's move to IFRS 9 for measurement. That we'll do in the next class, okay? I want to say that IAS 32 is the gatekeeper. It asks only one simple question. Do you have a choice? If the company has no choice but to give up cash or assets, it is a liability. You have no choice. You have a gun to your head. You must give up cash or you give up other assets. Then it is a liability. But if the company has total control over the payment that it will make, it is not a liability. It is equity. This is how to know it. So thanks for watching. If you enjoyed this class on IAS 32, I urge you to subscribe so that you don't miss the next class, which is on the main thing, IFRS 9, financial instruments. So my name is Echela Okori, Finance Simplifier. Share, like, and subscribe to this channel. Bye for now.